Hello, everybody. We're delighted to welcome Japanese company Daiwa Asset Management to talk us to this morning about the Japanese macroeconomy. And this macro point will be presented by Mr. Kogo Horie, senior strategist at Daiwa.
Yes, so thank you for introducing me, Jerome-san. And hello, everyone. My name is Horie, and I'm equity strategist at Daiwa Asset Management in Tokyo, Japan. Today, I would like to explain the outlook of Japan's equity market. So let me share today's meeting material. So please see page 2. Page 2 is our investor view on Japanese equity market and outline what we will explain today. Our fundamental view on Japanese equities has not changed. We continue to recommend a bullish stance on Japanese equities. Our reason for recommending Japanese equities are, first, uncertainty over the Japan's monetary policy has receded after the July monetary policy meeting. Second, Japan is a different business cycle from US and Europe for the time being due to the effect of delayed reopening. Third, we can expect Japan to enter a moderate inflation environment that is desirable for the equity market. Fourth and lastly, expectations for Japanese companies to transform are increasing due to requests from the TSE to listed companies. In addition, we believe the manufacturing sector, which is currently experiencing a different business environment, will enter an inventory cyclical recovery phase next year. And the favorable performance of Japanese equities during this phase is also a positive factor. In fact, Japanese stocks underperformed US and Europe equity market in July. However, Japanese stocks outperformed during the downturn in US stocks in August. And for these 2 months, Japanese stocks outperformed US and European equity market. Next page, please. Page 3 is our main market outlook. In fact, to our end of 2023 forecast, there is the August sell-off and it's now above our end of 2003 forecast. After the FOMC meeting in this month, we'll reconsider the market forecast. But in any case, we believe Japanese equity market is in a position to accept sufficient returns by the end of next year. Page 6 is a page that shows differences between the business cycle in Japan and Europe and US. The lower left figure shows the trend in the strength in infection disease control measures with respect to COVID-19. Compared to other countries, Japan has lagged behind easing its infection disease control measures. The lower right chart on this page shows the OECD CLI. Due to delay in easing of infection disease control measures, Japan's CLI composite leading indicator is firm. In addition, the US Summary of Commentary on Current Economic Conditions released this week, so-called Beige Book, indicated the decline in US forced saving is making progress. As shown in the upper right chart, Japan's forced savings are still in the post-COVID-19 high range, suggesting that domestic demand in Japan may remain relatively resilient going forward. Please see the page 7. I would like to briefly comment on the US economy and US equity market. Since Japanese stocks tend to underperform when US equity markets are rising in a straight line, so views on US stocks are important for investment decisions on Japanese stocks. Since the beginning of August, when we prepared this material, we have noted the strong US economy poses risks to the stock market, such as prolonged rate hikes. In fact, US stocks fell in August, as this strong US economy alerted investors to the possibility of higher neutral interest rate. Currently, this concern about US equities had receded compared to the period of time. However, as the upper right-hand chart showed, the GDP tracker is still high, suggesting continued strong US economy. For this reason, we still believe caution is warranted. Page 8 is a key point of Fed Chair Powell's remarks at the Jackson Hole Symposium. In this speech, Chair Powell don't make explicit statements such as neutral interest rate may be rising. After this speech, concern about the possibility of a rise in a neutral interest rate in equity market receded. However, as indicated on this page, Chair Powell noted the US economy has not slowed as much as expected. We believe that the risk the neutral interest debate could resurface. With page 9, page 9 summarizes the change in the dot chart of FF rate. As the chart below on this page, we are worried of risk that the end of 2024 year outlook for the policy rate and the longer run outlook could be rounded up at the September meeting or another FOMC meeting in this year. Please see the page 10. As lower left chart shows, the easing of labor supply and demand in US is slow. Therefore, we believe there is still downside risk in US equity market. In this environment, there are ample room for Japanese equity to outperform US equities and remain bullish Japanese equities. Page 11 to page 13 are about Japan's monetary policy. In the July monetary policy meeting, the BOJ decided to make the YCC operation more flexible. The specific details are shown on page 12. As shown in the upper right chart on page 11, after the MPM in July, the mainstream expectation was Japan's next monetary policy adjustment would be in April of next year or after 2025. We believe uncertainty over the Japanese monetary policy has eased for the time being, which is positive for Japanese equities. We believe YCC could be abolished as early as the first half of 2024. However, we expect the negative interest rate policy, which have a greater impact on the domestic interest market, will be abolished after 2025. The reason for this are shown on page 13. Deputy Governor Uchida, a key person at the current BOJ, has commented that the elimination of negative interest rate policy will occur only when inflation heats up and the economy needs to slow down. We believe such a situation is unlikely to be reached at the next spring, and Japanese monetary policy will remain at this current accommodative level for the foreseeable future. Page 14 to page 16 are Japan's inflation environment. Our view on inflation in Japan remains unchanged. We expect the current inflation, which is mainly driven by the higher import price, to gradually subside. On the other hand, as shown in the lower right-hand chart on this page, we expect service inflation to remain slightly positive and inflation to moderate to around 1 to 2% year-on-year basis. We believe this inflation environment is desirable for the stock market. The bottom left chart on page 16 shows Page 17 and page 18 are about Japan's ocean discharge of treated water from nuclear power plant and ensuing Chinese opposition. Japan began discharging treated water from Fukushima Daiichi nuclear plant into the ocean in this August. China strongly opposed this and decided to embargo Japan's marine products. However, as the table at the bottom of page 17 shows, impact of this embargo on the Japanese economy is extremely minor. An important matter for the stock market is to what extent this Chinese backlash will affect Chinese demand for travel to Japan. On August 10th, the Chinese government lifted the ban on group travel to Japan and other countries. The upper right chart on page 18 shows the number of Chinese travelers in Thailand. Since February of this year, the ban of Chinese group travel was lifted. The number of Chinese travelers in Thailand has recovered significantly. Japan was also expected to make this contribution. As shown in the table below left, a positive contribution of about 0.2 to 0.3% for nominal GDP was expected over the next year. But this has become uncertain. The lower right chart shows the number of travelers from China in 2012. The last time the anti-Japanese movement was on the rise. After a significant decline on August 2012, it will take about a year to recover to some degree. We believe the Japanese inbound demand is on the road to recovery and will continue to recover. However, the pace of recovery is becoming uncertain due to the anti-Japanese sentiment in China. Focus in near term will be on trend in the overseas travel by Chinese nationals during China's National Day. We're closely watching to see if there is a significant drop in number of travelers to Japan. Page 19 is about inventory cycle. Earnings momentum in the manufacturing sector, especially for high-tech products, is poor at the moment. However, as the lower left chart and the right chart shows, we believe inventory adjustment is the bottom range. Therefore, we believe inventory cycle will begin to improve in 2024. The upper right chart shows inventory cycle and topics movement. As chart showed, the topics returns are generally favorable when inventory cycle is recovering from the bottom. We believe this is another supportive factor for Japanese equity. Page 20 to 25 are development related to the TSC's request for cost of capital cautious management. This is a point of high interest from investors, mainly overseas investors, on the catalyst for the Japanese equity market. The specifics of TSC's request can be found on page 20 to 22. The TSC's request is characterized by the fact it asks listed companies to manage their business with an awareness of capital efficiency. In particular, strongly urges companies with PB of less than 1 time to improve. Each company is required to disclose its policy on how to respond to TSC's request, and the status of disclosure is shown on page 23 and 24. The table shows the status of TSC response for topics 1000 index constituent, with fiscal years ending in February and March. As shown in the table of this page, as of mid-July, when almost all companies had completed their earnings announcement, 1/3 of companies have announced their response policies. Specifically, Many companies had announced ROE and ROIC targets, as well as target for shareholder returns. A table on page 24 shows the disclosure ratio is relatively high, especially for low PB stocks, suggesting that companies are aware of TSE's requirements. We are particularly interested in the ROE and dividend payout ratio target shown on page 25. As the chart at the bottom shows, many company targets are ROE of from 7 to 8% or 10%, and the dividend payout ratio of 30% or 40%. This ROE of 10% and the payout ratio of 40% are high target for Japanese companies so far. TSE requests listed companies to discuss their response policy to requests as soon as possible. So we expect many listed companies currently don't discuss their policies will do by end of this year or around March of next year. If an increasing number of companies set their dividend payout target at 40%, this will clearly strengthen the shareholder return. We believe investors will pay even more attention to Japanese stocks. Page 26 is a comparison of ROE and different analysis for ROE of major companies in Japan, US, and Europe. Comparing Japan and US, we can see that there is a large difference in ROE or net profit margin. For this reason, it has been pointed out it is not essential for Japanese companies to aim at improving capital efficiency due to TSE requirement. Indeed, the difference in financial leverage is small on a weighted average base. However, as lower left chart shows, the distributor shows that there are many stocks in Japan with low levels. For Japanese companies to improve their ROE, they naturally need to improve their profitability. However, many Japanese companies have significant room to improve their ROE through increased financial leverage. From this perspective, we believe the TSE's request for the capital efficiency conscious management is an important move, as it is expected to have a positive effect on improving the ROE of Japanese companies. To summarize today's presentation, we have four main reasons for recommending Japanese equities. First, uncertainty over Japanese monetary policy has receded after the July monetary policy meeting. Second, Japan's business cycle differs from that of US and Europe due to the delayed easing of COVID-19 regulation. As a result, Japan's economy is expected to remain firm for the time being. Third, Japan can be expected to enter a moderate inflation environment, which is desirable for the stock market. Fourth, and finally, the growing expectation for the changing Japanese company as a request of the TSE. We don't expect US equities to rally in a straight line, as uncertainty still remains regarding US monetary policy. In this environment, we believe Japanese equities, with their own catalysts, can be expected to have good return potential. That's all from my side. Thank you.
So thank you very much for all of this presentation and all of this information. It's really interesting. So I have some questions. First, as mentioned on page 16, Japanese stocks have historically performed well when CPI was between 0 to 2%. It's still okay to assume that inflation to take hold at around 2% this time too?
To answer your question,
Yeah.
You are on the track. When the CPI is between 0 to 2%, Japanese equities have performed well in the past, and moderate inflation will contribute positively because the equity prices will use nominal CPI, and that will be reflected in the moderate inflation for the environment being right now.
Okay, thank you. So the second question that I have is regarding the exchange rates. I believe that many Japanese companies are exposed oriented. What is the assumed exchange rates for these companies? If it's set lower than €1 to 160 yen, how do you view the upward revision of corporate performance? Would you be a material for earnings?
We don't have the exact data, but 160 yen, the expect rate is, we assume it's lower. In the midterm earnings, there will be a revision, and we assume if it's in the midterm earnings, there will be a revision, and it should be considered as positively. So, there should be an upward revision for the midterm,
Okay.
which is September end.
Okay, perfect. So I have a third question. Regarding the Bank of Japan, it's possible that interest rate normalization could be accelerated support by holding of moderate inflation. And what impact would interest rate normalization have on Japanese stocks?
Okay, so if they remove the minus interest rate or the yield control earlier, the interest rate is likely to rise, which will lead to stronger Japanese yen. Stronger Japanese yen will lead to little bit of a negatively to the equity market, but the amount should be limited to about 5% on topics level.
Okay, perfect. So this is my last question. The topics forecast on page 3 for CI 2023 is 2.250 point level. Looking from the current level, is the market currently overbought? Therefore, the question is the same as the title on page 33. When is the best time to buy? When should we enter the Japanese equity market?
I believe if we are to consider, as I mentioned in this presentation, the Japanese economy is in the delayed reopening stage. If you look at time horizon for 1 year time horizon, I think it's a good timing to enter the Japanese market at this moment.
Okay, perfect. So thank you everybody for this very precise presentation, and all your answer was very interesting. And thank you very much for everything.